Tomorrow, we welcome back the chairman of the committee, Congressman John Spratt of South Carolina. Mr. Chairman, always good to see you, sir. Welcome back.
Thanks for having me.
You know, we seemingly are getting some green shoots in this economy, in housing, in other areas right now. The markets have come back a bit. The steepening of the yield curve seems to signal that the market's anticipating a recovery in this economy. I'm curious what you want to hear from Fed Chairman Bernanke tomorrow.
Well, that'll be one of the first questions we put to him. Are we seeing glimmers of hope, or are these simply flashes in the pan?
What do you think?
I'm hoping they're glimmers of hope, but there are also other events that cause you to wonder and worry.
Like,
for example, traditionally in the past, in recessions of this kind, automobiles and real estate have been the locomotives that have driven us out of recession. What's there available now to drive us out of recession by the end of this calendar year, which is what the Fed is predicting?
And one of the issues also, Congressman Spratt, is the issue of inflation. We're printing a lot of money. We're issuing a lot of debt. There are some who think that what we're seeing in the credit markets right now is telling us that it's not growth that we're looking at and recovery that we're looking at, but it might be sizable inflation worries down the line. Do you share those worries or not?
That's a concern. I don't know exactly how to play them out, but Bernanke can give us a professional answer better than anybody I know. That's his field, that's his expertise, and certainly we'll be pressing him on that issue too. Unemployment is a big problem, however. If you live where I come from, South Carolina, the Carolinas, in the Charlotte area, metropolitan Charlotte, we're looking at double-digit unemployment that is the second worst in the nation. My home county, 14.5%. The surrounding counties as high as 20%. It is brutal. And so that's a big concern and a primary concern that transcends the others.
What are you going to ask him when it comes to regulation of the financial markets?
Well, that's for other committees to pursue. We'll be asking him more or less, what about the budget? What impact can we expect on the budget? For example, with all of the assets we're acquiring, the preferred stock we're buying in connection with the TARP funds, to what extent can we expect this to be repaid so that it will come back to the Treasury and help us reduce the national debt instead of adding to and augmenting the national debt?
Are you going to ask him about what happened with General Motors? I know that was done by Treasury, but there's a lot of TARP money in there. Is that going to come up at all?
Well, that's part of the question I just put. How much and to what extent can we expect this money to be paid back so that it will simply be a loan that is realizable, that we can actually recover and apply to the debt we've incurred?
Jerry?
Mr. Congressman, your history, your track record has always been anti-deficit. And I know you said earlier this month you're looking for it to come down over the next few years, somewhere down in the $500 billion range. How long are you willing to let this go? And what are your leading indicators over the next 12 months that says the deficit reduction will be on the right track?
In our budget resolution, we take the ball where it lies. $1.8 trillion, $1.7 trillion in deficit this year. We build that down, bring that down next year to about $1.1 trillion or $1.2 trillion. And by the fifth year, 2013, we get the deficit down to $525 billion. I think that's the best that we can hope for, given the circumstances we've got right now. I think it's credible because the existing deficit, which is large, is unprecedented, is also swollen by some non-recurring one-time events like the TARP loans. And once we get past those, I don't think you'll see those recur in out years. Therefore, we'll be able to diminish the deficit because these things will not be recurring factors.
What would cause you over the next year on the way down to 1.1 to say we're not getting there, we're not on path? When would you intervene? What would you change?
I can't give you a number, but if we're not tracking the numbers we set out in our budget resolution, then we would be on the House floor and elsewhere within the House and the government saying we need to do some mid-course corrections.
Is this working? I mean, we've debated that ad nauseum, but I'm curious your thoughts on the TARP program and the amount of money. I mean, when you roll off the tongue there, $1.8 trillion in deficits for a year, I mean,
it's staggering, no question about it.
Is it worth the price tag of what we're doing right now, what we're trying to do to recover this economy? Is it working?
Well, if we weren't doing it, what would be happening? This is an unprecedented recession. It's the worst since the Great Depression. Do we simply stand by and let it play its course out? If we do, we run the risk that this would get out of hand and that the deficits would be terribly difficult and that the credit system would collapse. I don't think we want to see that happen, and we couldn't take the risk that it might happen.
But, you know, the free marketeers say, and maybe you can make your own argument, but they say let the chips fall where they may, and let those who, the weak links in this economy that don't deserve to survive, let them go by the wayside, and let the strong
can you say General Motors
survive?
Well, that's cavalier economics in my book. I don't think you run the risk of having the catastrophic consequences we'd be faced with. And I don't think in the case of General Motors that you would want this economy not to have that industrial backbone, which is a key part. It's hard to imagine our economy without General Motors, Chrysler, and the big three, assuming some part of automobile production in this country. So I wouldn't want to even fathom the possibilities there, but I think we're doing the right thing. Let's hope it works.
Congressman, one of the worries in the market today and for the past week has been the precipitous drop in the U.S. dollar, which of course has grave economic circumstances if it continues for the U.S. economy. Do you think that the administration is actively trying to push the dollar down, even though Timothy Geithner, the Treasury Secretary, said on our air that they have a strong dollar policy? We've heard that from almost every administration.
I don't think so. I don't think they're trying to push the dollar down, because if you do push the dollar down, there may be some point at which you can't pull it back up again or stop this decline. So I don't think they'd be playing with anything as risky as that in these circumstances.
What do you think of the job Chairman Bernanke's doing? He's not, I don't know, are we reading too much into it, or it doesn't seem like he's getting the greatest vote of confidence from the administration?
Well, I think we're fortunate to have someone of his ability, character, and high intelligence in the position he's in today. You couldn't find anybody better qualified to understand the recession. He's made a lifetime study of recessions. And so
there are heavy rumors that Larry Summers would eventually have that job. Would you be supportive of that?
Well, Larry Summers is a good friend, and Ben Bernanke is a constituent, so I won't declare myself.
Mr. Chairman, we'll be watching tomorrow. We got live coverage coming up tomorrow.
Very diplomatic.
Thanks for joining us today, sir. John Spratt, who chairs the House Budget Committee.
I forgot about that, yeah.
And we will have, he knows who's voting down there. Come on.
He does.
All right, are hedge funds and private equity shops ready to lever up again? Have we learned nothing? What does the answer to the question tell investors about mergers and acquisitions in that arena? We're going to talk about that with a guy who should know.